Ladies and gentlemen, good day and welcome to Q1 FY23 earnings conference call of Nuvoco Vistas Corporation Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gavin Desa from CDR India. Thank you, and over to you, sir.
Thank you. Good day, everyone, and thank you for joining us on Nuvoco Vistas Corporation Limited's Q1 FY23 earnings conference call. Heading the call today is Ms. Madhumita Basu, Chief of Strategy and Marketing. Before we begin, I would like to mention that some of the statements made in today's call may be forward-looking in nature and may be viewed in conjunction with the risks and the company faces. The company does not undertake to update them. The statement in this regard is available for reference in the presentation shared with you earlier. We will begin the call with opening remarks from Ms. Basu, who will share perspectives of the business model and strategy and the outlook of the company. Post this, we will have the forum open for interactive Q&A session. I would now like to hand over to Ms. Madhumita Basu. Over to you.
Thank you, Gavin. Good evening, everyone, and welcome to the Q1 FY23 earnings call of Nuvoco Vistas. I would like to open my commentary mentioning that the recovery in Indian economy is gaining strength with visible signs of improving credit growth, pickup in investment activity, second highest GST collection in July 22, and an 8-month high manufacturing PMI figure last month. In its recent Monetary Policy Committee meeting, RBI has also retained India's growth projection at 7.2% in FY23, while taking a note that the headline inflation has flattened. But we remain watchful of elevated risks emanating from protracted geopolitical tensions and its consequent impact on supply chain bottlenecks and elevated energy prices. India remains one of the fastest growing economies in the world. As we know, it is the world's second largest cement market with a low per capita consumption, providing significant headroom for growth. Government's consistent focus on affordable low-cost housing segment and increase in infrastructure spend augurs well for cement demand. Housing shortages, especially in East India, is being bridged through programs like PMAY, in which the government has targeted to complete 80 lakh houses during this fiscal. Positive momentum is also expected in urban housing, with growth in individual income levels and positive change in the demographics. Rural demand is also set to pick up with robust rabi crops and better crop realization. Release of government's allocated funds towards infrastructure development is also expected to pick up pace with run-up to the general elections in 2024. Focusing now on the cement industry in Q1 FY23, this quarter witnessed cement demand growth in East and North by 11% and 17% respectively on a YOY basis, albeit a low base effect of the previous year. However, we have seen improvement in demand from PMAY and pickup in demand from real estate and infrastructure projects. There was a slight dampening impact of the high inflationary pressure, particularly May onward. On the prices, price hikes were taken in late Q4 FY22 and remained supportive during the quarter. Both East and North witnessed further price hikes in April on this already high base. However, there were some partial rollbacks in May and June, and resultant price hikes were not enough to offset the impact of the elevated energy costs. In the near term, we would like to take a cautionary view as we have entered a seasonally weak quarter. Cement demand is expected to dampen in near term before gaining momentum with improvement in construction activities post-monsoon. Amidst weak demand, prices in both East and North softened a bit in July and is expected to remain under pressure. At the same time, energy prices continue to be at record levels. While we have started seeing some cool off in the petcoke prices recently, the benefit of this should start coming from early October with the current bookings at lower cost. Linkage coal availability is also expected to improve from September onwards with the withdrawal of monsoon. Consequently, this would weigh on near-term profitability for the industry. In this backdrop, we would continue to focus on our internal levers, getting maximum linkage coal available and increasing the rate of alternate fuel. I would now like to give you a quick update on our ongoing expansion projects. We are on track on the clinker capacity enhancement projects in Vistas and Nuvoco through debottlenecking. Civil work for the new 1.2 MTPA grinding unit at Bhiwani, Haryana is almost ready to commence. We have placed orders for key equipment and materials. This expansion will leverage our existing channels and help in quickly augmenting our sales volume in the region. On the sustainability front, we continue to pursue several sustainability initiatives focusing on enhancing use of alternative fuels, improving the share of composite cement, and conserving natural resources. I am happy to share that Nuvoco has signed the membership with Global Cement and Concrete Association last quarter. The purpose of GCCA is to identify actions and facilitate steps for cement companies to accelerate progress towards sustainable development, covering varied aspects of energy, climate change, circular economy, and SDGs. And we shall be playing an active role in this partnership going forward. During the quarter, we have improved power through our waste heat recovery system. Alternate fuel usage in our overall fuel mix also improved compared to Q1 FY22, standing at 6%. Our investment in the alternate fuel material handling facilities in Vistas and Nuvoco are progressing well, with key equipment for co-processing solid waste system at Vistas already under erection. This investment will not only help in furthering our sustainability goals, but will also help us to greatly offset the high energy prices. I will now briefly touch upon our ready-mix and MDM businesses. Both the businesses are performing well. We have opened a new ready-mix concrete plant in Mumbai last quarter. Our value-added product mix in ready-mix as a percentage of the total sales has also improved to 28%. In modern building materials, we have extended our customer reach with expansion into the non-cement channels. Moving on to our financial performance for the quarter, our consolidated cement volumes improved by 11% YOY to 4.7 million tons in Q1 FY23. Our revenue from operations improved by 20% YOY to rupees 2,652 crores, driven by higher volumes and price increases in both East and North. Some quick comments on our three cement cost elements. Despite inflationary pressure and higher consumption of slag with ramp up in our composite cement volumes, raw material costs per ton remained flattish on YOY basis, while declining by 14% quarter on quarter. The team concentrated on containing the power and fuel costs during the quarter. You would have observed that the upward shift in power and fuel costs by rupees 122 per ton sequentially was well below the industry average. This was possible with efficiencies under our internal levers program, a well-optimized fuel mix, despite lower availability of linkages. As the energy prices remained elevated, however, coupled with the high-cost inventory in the beginning of the quarter and lower availability of linkage coal during monsoon, this cost should likely peak in Q2. With petcoke prices softening and expected improvement in linkages post-monsoon, Q3 should witness a decline in this cost chain. Distribution costs during the quarter increased by 15% YOY and 10% quarter-on-quarter, mainly as we had to move our clinker through road transport due to severe shortage of rakes in eastern region, which led to additional costs. However, the situation has since improved. Our consolidated EBITDA for the quarter stood at rupees 374 crores. We continue to focus on our internal levers, which is helping us to navigate through these tough times. Broadly touching upon some highlights, our share of premium products of total trade volumes improved by 1.6 percentage points on a YOY basis, standing at 34% in this Q1. Project Sprint, which is to get synergies with the integration of Vistas, has been continuously on track. Benefiting from highest ever power generation through waste heat recovery system. Our net debt during the quarter increased to 5,347 crores as on 30th June 2022. This was primarily due to higher working capital requirements amidst steep rise in fuel prices and the seasonal nature of the business. However, our finance cost has been witnessing a declining trend with debt repayments and a well-managed interest rate in these volatile times. Our interest cost increased by 30 bits compared to the 90 bits increase in repo rate during last quarter. Total capex for the quarter stood at 73 crores. With this, I will be ending my opening remarks. I am joined by Mr. Jaikumar Krishnaswamy, Managing Director, Nuvoco Vistas, along with Mr. Manish Agarwal, our Chief Financial Officer. We are all here to address your questions. Thank you.
Good evening, ladies and gentlemen. Jaikumar here. Good evening, this is Manish Agarwal.
Devin, you might like to open the question or answer session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Ankit Patel from L&T Mutual Fund. Please go ahead.
Yeah, good evening. Thank you for the presentation. I have two questions. One is regarding the capex plans. You did mention a capex number for the quarter. I just want to understand the overall capex plan for the next 1 to 2 years or foreseeable projects that you have put in place. And my second question is around the current debt levels of the company. Just want to understand how you plan to what are the plans in terms of refinancing and the upcoming maturities, how you plan to address them?
Okay, I'll take this question, Ankit. Good evening to you and to the rest of the people. First, let me just talk about the capex plans for the company. As mentioned during our last call, we have not changed anything from what we mentioned in the last earnings call. The capex plan for the company is divided into two parts. The first one is the brownfield expansions in 4 of our plants. One is in Nimbol, where we are increasing the clinker capacity by 1,000 tons per day. And the second one is in Risda plant. Again, we are increasing the capacity of clinker by 1,000 TPD. The third capex plan is Bhiwani GU, which we have announced, increasing the grinding capacity in Bhiwani to 1.2 million tons. And the last one is setting up alternate fuel capability in Risda and Nimbol. In addition to that, a couple of railway sidings are being constructed in the companies in Sonadih and Jajpur. These are all the large capexes which we're talking about. And then in addition to that, there are routine capex in the organization. Overall, in this year, we're looking at a capex anywhere between 500 to 600 crores. That's the kind of window we are looking at. And then, as mentioned last year, we also have our expansion in West and North in the offing, and that should happen early fiscal next fiscal. And as I mentioned during the last call, based on the outcome of this year and as we are going through a little bit of the industry itself is going through a little bit of a challenging times with fuel prices, I had mentioned in the previous call that the exact date of groundbreaking for these new projects we will decide during the course of this year. And as and when it happens, I think during our call I will exactly mention when this is going to happen. But as it stands today, the short-term capex for the company envisage clinker debottlenecking, railway siding, and the GU. All these are likely to be completed in the next 12 to 15 months. By September next year, all these projects will be upstream. Many of them will happen as we speak, but then the last one will be commissioned September next year. The greenfield sites and the expansion projects of the company, during the course of the year, I'll come back to the investors and exactly tell when we are doing the groundbreaking. That's about the capex. The second point which you mentioned was about the debt program of the company. Here again, I think I'm going to be saying some of the things which I mentioned last time, so we'll have a consistency in our approach. I think we are very clear as a company that the current levels of debt and the normal course of business which we have for the next few years, by 2026, we should be technically a debt-free company. But like I mentioned in the last call, we as a company, as a group, we are comfortable operating with a debt level of about 3,500 to 4,000 crores, and balance we would like to fund the growth opportunities for the company. And that's where we stand. And I think all our plans in the next few years are based on the current capex and in the reducing the debt to paring the debt to about 3,500 to 4,000, on the side by side expand the companies in West and North India. So that's the details about capex and debt for our company, Ankit.
Right. Thank you. I'll come back. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Satyadeep Jain from Ambit Capital. Please go ahead.
Hi, good evening. Thank you for the opportunity. A couple of questions. One is a follow-up to Ankit's question on debt. Just on the covenants, what are the covenants for debt, and is there any maturity? Can you also talk about the maturity schedule of debt? Is there any big bullet payment that is coming up for refinancing or maturity in the next 12 months or so?
Okay. As regards the covenants, I'll have to inform all of you that we are well within the covenants which we have currently, and then in the coming future, any of the quarters going forward, I think the business plan as well as the model, as well as operations, as well as results of the company are fine enough to meet any of the covenants, and we don't see any apprehension or risk on that. As regards the bullet payments or what are the payments which are likely to happen in the next 12 months, I'll ask Manish to share with you the bullets which have to be retired or refinanced in the coming 12 months.
So we have a net repayment of 600 crores, which is due in FY23. And out of this 600 crores, we have already repaid 130 crores. The balance will be taken care of from the operation.
So you're saying 600 crores in FY23. Any idea on FY24 also?
Yeah, it will be through over around 1100 crores plus.
1100 crores.
That's right.
And outside, I know the operating environment is outside of the company's control in terms of earnings and stuff. Beyond any earnings improvement, is there anything that the bankers can also maybe ask you to look at some asset divestitures? Is that going to be totally off the card for you guys to look at any possibility of asset monetization, whether it is land or any asset?
I don't think we have any such plans. I think we are having, I think even though there is a small issue regarding the overall cost pressures in the industry. But I think we are on a sound wicket, and then we are comfortable and confident with the business model which we have. As I mentioned in the last call, all our investments and capex programs are going to be kind of moved a quarter or here and there. That's what I mentioned in the previous call. I think we are sticking to that. And I think unless until some major MAC event happens, I don't see any concern for the industry as a whole and Nuvoco specifically.
Good to hear. Just one quick follow-up on the slag pricing in the market. Given the reduction in steel supply in the domestic market after the export duty cut, are you seeing some tightness for slag or increased prices at all for slag in the market?
Look, as I mentioned in my previous call, so I'll just give you a little bit of overall slag requirement for us and how are we tied up. We have a long-term 20-year slag tie-up with Tata Steel in Jamshedpur, and we also have yearly or 3-yearly contracts in other steel plants in the nearby eastern area. And the tie-up with Tata Steel is such that we have a assured slag availability of close to about 2.1 million tons per annum. And on top of it, we also have, that's on a rate which we have finalized with them. And then on top of it, we also have close to about 0.4 million tons of slag supplied by them on a market basis. But combination of 2.1 and 0.4 is quite less than the overall slag Tata Steel generates, which is much higher than what we are consuming. They are also selling to other companies. So our requirement of 2.5 million tons is secured and not a issue at all. And as we speak, in the last 3 months of the prior quarter, we have adequate slag to run our business in all the plants in East. In addition, as regards to other plants, I think all of us are aware that time to time all these companies are getting into an auction mode, and we have to be on the auction mode to get slag from any of the other steel plants, and the same environment holds good for us like for other companies. So if there's going to be a major event in slag availability, I think the whole industry might have a challenge, but we have a little bit of a head start on that with our slag tie-up for 20 years with Tata Steel.
That's good to hear. So I do understand Nuvoco is better positioned compared to competition given the long-term contract with Tata Steel. But generally, if the players, your competition also had to go out in the auction markets to buy slag, are you seeing some pricing increase or maybe cost increase for your competition in that market?
Actually, I have to say that as we stand in Q1, which is the quarter ended and currently, if you look at, as you track the market, same time last year, slag was like a very hot commodity actually. Slag prices went as high as 1,800, 1,700 rupees per ton. And many a times we had to simply walk away because we didn't want to pay so much of price for slag. But compared to that kind of pricing which used to prevail a year ago, currently the prices are not that high. So it is still trending at about 1,200, 1,300. So I think it's not reached the stage like last year. So I don't foresee a major challenge as we speak, unless and until a major event happens, like they all kind of shut down the steel plants for months to come. So, but right now, we are on okay wicket.
Okay. Thank you so much.
Thank you. Next question is from the line of Tejas Pradhan from Citigroup. Please go ahead.
Hi, sir. Could you share the consumption cost of coal and petcoke on a blended basis for this quarter? And along with that, based on the inventory, etc., that you might be having, what could be your guidance on the power cost increase that could be seen in the next quarter?
Okay. Our company is uniquely placed in East as well as we have in North. In North, the entire coal is either imported petcoke or local petcoke or imported coal. That's how we run our North, both the factories in North. In East, we have linkage coal for all the factories as well as domestic coal, imported coal and petcoke options. So I will not be able to, not a question of not be able to, but I really don't want to give line by line what is the mixed cost and all this stuff. But let me give you a little bit of a high level number. In the quarter which went by, our blended fuel, power and fuel cost for the company was close to 1,370 rupees per ton. And on a comparable level with the previous quarter, it had increased by close to about 10%. It was about 1200 odd and 1285 to 1370. Yeah. Whereas same period last year, we were trending close to about 885. So you would be tracking every company, and I guess everyone's fuel prices have gone up. So we are at 1370, which is a blend of linkage coal, pet coke, and imported coal. As regards specifics of rates at which we have bought coal, in the quarter which went by, we bought imported pet coke as high as $250 to $260 per ton, and domestic imported coal was also around the same price. Domestic normal coal was in the range of about $220 to $230 per ton, and linkage coal, obviously, we had a challenge with getting the full quantity of linkage coal. Like I mentioned in the last call, we started getting allotment of linkage coal, but still we have not got full quota of linkage coal for us. I only wish and hope once the power crisis in the country diminishes, we would get our full quota of linkage coal. Typically in East, we use about 30% of the overall coal requirement from the linkage coal type which we have. But on a positive side, in the quarter currently we are in, we now have formal linkages for all the captive power plants in Vistas, Arasmeta as well as Jojobera. And when we enter October this year, we should get our linkage coal quota for the captive power plants in all the plants in East. You also would know the coal which we bought, fuel which we bought a month ago or 6 weeks ago or 10 weeks ago will be sufficient for us till end of September. And we are at peak level of fuel prices for our company. I'm sure every industry is there because of the inventories which we hold till end of September. We are contracting coal at much lower price at about $170, $180 of pet coke, and domestic or imported coal is trending at about $220. So I guess from Q3 October onwards, the fuel prices will come down substantially from the current trending fuel prices.
Sure. Just if you could quantify for the second quarter, 2Q FY23, what percentage increase can we see in the power cost, if possible?
I think that would be kind of giving us guidance. Yeah, Mita, you want to answer? Yeah, go ahead.
Tejas, it's a little early in the quarter, but we will connect with you and keep you updated as the quarter progresses.
But suffice to say, we are at the peak of coal fuel prices right now. So we have reached almost the tip of the iceberg, and I think as we travel this quarter, we might have to continue with the current prices, and when we end the quarter, things will soften and Q3 should be better than where we are currently.
Sure, thanks.
Thank you. Next question is from the line of Prateek Kumar from Jefferies India. Please go ahead.
Hello. Yeah, good evening, sir. Ma'am, first question on Project Sprint. So when we say we are on track for the savings there, so would you be able to quantify, like, versus our 250 per ton of targeted saving, how much by FY23 end? Where do we stand now?
Yeah, thanks for the question. As we clarified in our last call, Sprint is a program which we do not look at a quarter-upon-quarter improvement because projects have been front-loaded and these are under continuous monitoring and tracking. Our previous plan was 150 INR per ton in FY22 and 100 INR per ton additionally in FY23. We are on track on these numbers. The 2 or 3 levers which we are working on is our WHRS. As the capacity utilization improves, we see uptick from this. Secondly, as Mr. Jaikumar just clarified, we are seeing an improvement in our CPP once the linkage coal connection comes in Q3. That should bring a good uptick in the program. We are also pursuing our composite cement program with passion as well as working on improving our premium product levers. So with primarily these levers being accelerated in this year, we see Sprint well under control.
Sure. Thank you. Secondly, on the cost front for the quarter, so other expense appears like we have had like a 15% Q-on-Q drop in volumes, but our other expense looks flattish. Also, freight expense on a per ton basis, as you mentioned, have increased sharply Q-on-Q at 10%. You mentioned about the rake shortages as a reason for freight, but is there any change in lead distance which is impacting freight, and what are the reasons for increase in other expense?
So on freight expenses, as I clarified, we have had an impact of rate availability for our clinker and cement movement. So this situation has improved, and we see this will be reflected in the quarters to come.
So just a background to what Meeta said, one of the biggest challenges which I'm sure all of you would have heard before as well in East, because of this coal shortage, there was a guideline by the central government that all the wagons should be used to transport coal to the power plant. So the decision was taken by the Indian Railways to stop the industry, and all the wagons were diverted to power plant. And you would know our clinker manufacturing facilities are in Chhattisgarh, or vending units are in Jharkhand, Bihar, Bengal, and Orissa. Our model of running the business is to take the clinker from Chhattisgarh all the way to these states and then distribute in those states, which is a unique business model of our company, and out of which all the clinker other than Jharkhand factory typically is moved by rake. We typically used to get about 3.5 to 4 rakes per day for moving clinker, and that reduced to close to about 2 rakes per day, and on some days it used to be 1.5. And since to run the business, we took the decision of moving clinker by road, and that's one of the primary reasons for our distribution costs being higher in the quarter. But I have to inform all of you, once the quarter is ended and as we entered Q2, we have a welcome relief with rake availability has been restored to the past period, and now from July 1st onwards, we don't move any clinker by rake, and then the semi-finished, by road, and semi-finished clinker rates have come down to our normative levels of close to 250-260 rupees per ton. And we are back to our running rate of past period.
And sir, any no changes in lead distances in this quarter versus prior period?
Hardly any. Could be some 3-4 kilometers here and there. Actually, that's not of any material changes. I am just looking at it's Q1 was Q4 FY22 was 340, and Q1 FY23 is 335. It was 5 kilometers.
Just last question. Ma'am mentioned in the opening remarks that cement demand is expected to happen in monsoon. So are we also talking about year-on-year, like sort of slipping into negative in general for the region, or is it just the sequential dampening we are talking about?
So firstly, we need to see that Nuvoco's footprint is 80% in East. And if we go back a little, the FY22 period saw cement degrowth only in the eastern region. We have entered this year trending Q1 to date at a double-digit growth. Come Q3, which was a badly impacted year for the eastern region last year, the cement demand should exponentially grow quarter upon quarter year upon year in Q3. We have a very positive outlook, primarily of eastern region demand being double digit, and there's consequent impact on us with an 80% footprint. Just additionally, Q1 has been a good quarter even in the northern region, with many infrastructure projects kicking in and a good uptick in demand. We are seeing a double-digit growth of almost 15-16% also in the northern market.
Sure, thank you, ma'am, for this one.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Thank you. Sir, what was the trade share in Q1 FY23?
Yeah.
75%, I would say.
Sorry, ma'am, I couldn't hear.
Yeah, sorry, it was 72% in Q1.
Okay, 72%. And the premium share?
Premium share was 34%.
Okay, same as the last quarter. Okay.
Yes.
And
1.6% growth on a year-on-year basis.
Okay. And in terms of the prices, you mentioned that after the April hike, it consistently rolled back month on month in May, June, July. So just wanted to know in July, from the average prices, how much decline we have seen, or from the June exit, how much decline we have seen in East and North in July and August till now?
July, we have seen some softening with the seasonally weak quarter. This has been roughly 5 rupees per bag. From the June exit prices.
This is both in East and North?
Yes.
Okay. Then just coming back again on the power and fuel cost, I know sir has explained on the per ton, rupees per ton 1370, but in terms of the consumption cost, put together everything, domestic, imported, coal, petcoke, what was the consumption cost for this quarter Q1 FY23, and what was the same in Q4 FY22? Or you can give in the KKL basis also, that would also fine.
Yeah, let me just give you. So Q1 FY23 with the quarter ended, we had linkage coal consumption of 16% of the mix, non-linkage domestic coal at 23%, imported coal 2%, and petcoke 53%, and alternate fuel 6%. So just let me repeat: linkage 16%, non-linkage 23%, imported coal 2%, and petcoke 53%, alternate fuel 6%. Compared with Q1 FY22, linkage coal was 26%, obviously 10% reduction. Non-linkage coal 23%, comparable 26% last year. Imported coal we had 25% last year. This year we used only 2%. Petcoke last year we used 20%. This year 53%. And AFR last year 3%. This year 6%. So there's a huge improvement in AFR usage. Linkage coal obviously has come down because we could not get full allocation of linkage coal, and petcoke we had to use because there was no other means of coal availability, and so it moved from 20% of the mix to 53% of the mix.
I got it, but in terms of the costing, I'm saying, so in terms of the dollar per ton.
Let me give you that also. I'll give you in rupees per million cap. Linkage coal Q1 FY22. Linkage coal 1.13, currently at 1.28. Non-linkage coal last year 0.95, this year 2.64. Imported coal last year 1.37, this year 3.3. Petcoke last year 1.53, this year 2.47. Alternate fuel last year 0.72, this year 1.45.
Okay, got it. Lastly, coming to the on the capex and the data again. So you mentioned the 500 to 600 crore capex this year. So in this, how much is the maintenance capex?
Yeah, the maintenance capex is the tune of about 150 crores.
150 crores. And next year, you said that it depends when we start the greenfield in Karnataka, Gulbarga. So last time we were looking at 1500 crore capex. So by next quarter, do we in a position to say that we will start the capex, or it can take 3-4 quarters to start the capex for the Gulbarga?
I think last time I'm going to be consistent because nothing has changed from last year to last quarter, this quarter, but for even more tighter situation in the external market. So I would stand to stick to my statement of last year. As regards expansion for the company in west and north, it's happening. It's a question of timing when we start. And in terms of exact time of groundbreaking, you give us next quarter. I think when we have a next quarter, I think I'll have better visibility in terms of exact kickoff time. But suffice to say, in the next 12 months, we will not be able to start Kolkata or any greenfield site.
Okay, got it. And lastly, on the debt front, you already mentioned the repayment schedule and want to become technically a debt-free by FY26, but also comfortable to have a 3,500 to 4,000 crore kind of a debt. So any broad idea in terms of when we say a debt-free, how much broadly cash flow that we are looking at from FY23 to 26, and what kind of a capex we are factoring when we are saying that we want to become a debt-free by FY26?
So I guess in our business model, which we presented 2 quarters ago, or also during our IPO time, we had a very clear-cut roadmap to take this company to beyond 25 million tons capacity and consequent sales with greenfield as well as the brownfield expansion which we had. And that's how we kind of derived the entire model of when do we kind of technically become a debt-free company. And in the last quarter, I came back and mentioned to all of you that by calendar 2026, we should be technically with the current business model which we have, we should become a debt-free company. But along with that, I also mentioned growth is a big ambition for the company, and for us to grow, it cannot be retiring debt is not the ambition for the company. Growth is the ambition for the company, and hence I mentioned we would be okay to run this company with a 3,500 to 4,000 crore debt, and the rest of the cash which we generate, we would like to invest on growth for the company. As regards to your question of exact cash flows in the next few years and capex plans, in this call, it would be very difficult to read out all the lines. I would request you to engage with our investor relations team. We would be happy to give you year-wise numbers so that you get your answer for the question you asked.
Sure, sir. Sir, lastly, UltraTech would be adding capacity of 9 million ton in the second half of this year in East particularly. Don't you see this will be a sizable number in terms of the incremental capacity which will put a pressure on the pricing in the East region where we are having a sizable presence?
Here, I think in all our calls, I think Meeta has explained. I will ask her to explain the logic of cement capacity as well as clinker capacity. Meeta.
So thanks, Shravan, for your question. We have engaged on this earlier too. In the context of East, we do feel that the capacity should be studied as the clinker capacity. And stands in the end of FY22, the capacity in the East is roughly 43 to 44 million tons. We have already taken cognizance of the UltraTech addition which is coming in this year, the Sri addition which came in a little earlier. All these together in the eastern regions in FY25, we are talking about clinker addition of an additional 10 million tons. So base 43.8 million tons with the cement to clinker ratio translates to about 72 to 75 million tons of cement, which is at the moment aligned with the market demand in the eastern region. With the 10 million ton cement clinker being added in the coming 2 to 3 years, at a cement to clinker ratio, again, this would translate to a 16-17 million tons. Now, the base effect of this, say a 75 million tons eastern region demand, we are looking at a 10% to 12% growth in this year, followed by an 8 to 9% growth in the years to come. So that is like a demand of 8 million tons being added in this region year upon year. So we feel that the numbers as they are stacking up now, clinker capacity will still be at a high of 85 to 90% capacity utilization, and the resultant cement from this clinker would just about balance the demand in this region. I would be happy to engage with you once again on a more detailed discussion on this model of ours.
Thank you. Thank you very much. All the best.
Thank you.
Thank you. Next question is from the line of Rajesh Ravi from HDFC Securities. Please go ahead.
Hello. Yeah, good evening, sir and ma'am. Sir, you mentioned on the per kilocal costing, you gave a detailed answer for Q1 this year and last year. Possible to enumerate the same for Q4? Per kilocal costing across different grades?
Can you hear us?
Hello. Am I audible?
Sir, you're audible. Let me.
Yeah. Can you hear?
Okay.
Yes.
Yeah. Hi, sir.
Let me just explain. I already gave you the order for sequence for Q1 FY22 and Q1 FY23.
Yes.
Just put a column Q4 FY22. I'll just read out the numbers which would help you compare all the 3 quarters. Linkage coal in Q4 was 1.26, as again 1.28 this quarter. Non-linkage coal was 1.62, which became 2.64 this quarter. Imported coal was 2.5 in previous quarter, it became 3.3 this quarter. Pet coke was 2.18, it became 2.47, and AFR was 1.1, it became 1.45. That's how the rupees per million cal moved from Q4 to Q1 this year.
And what was the mix, sir, in Q4?
Okay, linkage was 19% last quarter, non-linkage 18%, imported coal 25%, pet coke 32%, and AFR 6%.
Okay, so you have improved on your pet coke consumption, and that has also helped you. You have basically reduced on pet coke, imported coal, and moved on to pet coke.
No, because both of them are trending at same price, and North is all imported coal and pet coke. There's no domestic coal in North. So whichever is available at the lowest price, when we go book coal, so we just book that coal.
Okay. And sir, another question on your growth aspirations. We understand Karnataka market, you have a big mine which you need to reserve, conserve, and that is why this capex. But how about growth aspirations in the core market, primarily east and north? Would that be a more? What sort of opportunities we have if you look from a FY25 or FY26? Do we have meaningful brownfield expansion opportunities in these locations? Say 3 to 5 million ton additions possible?
Okay. So I guess we have spoken about it more than one occasion, so I guess I won't have anything new other than what I have mentioned before. If our ambition is right now in the next 5 years to grow in north and western markets. So in north, we have limestone mines available for us in Nagaur and Nimbaeda, and that should help us get our north project going at some stage. And for the western market, we are using the mines available at Gulbarga. Though all of us say it is the state of Karnataka, geographically it is in the border between Karnataka and Maharashtra, and our plan is to have a combination of IU and GU so that we are able to get the cement to western India where the realization is pretty good. One thing which has changed from 2 quarters ago and now is the realizations in western India even improved further to north, and so expanding in west is a good option. Likewise, expanding in north is also a good option. So our business model and our growth ambition is very clear that as the base of growth for Nuvoco will be in western northern India, subject to our government approvals and clearances. And I think based on the approvals, we will decide which one to kickstart first. As regards east, as we mentioned before, right now we don't have any plans to set up any greenfield or large brownfield expansion. But in terms of limestone availability for the plant, we got adequate limestone for all the plants for a minimum of 50 years.
Okay. And sir, when we see the industry expansion pipelines, big pipelines being discussed by most of the big guys, we see that north still remain less, aggressive capacity expansions in the north market. And given that you already have a strong distribution presence in that market. Wouldn't it be, more prudent and a low-hanging fruit for you to expand in the north market rather than go for the Gulbarga project, where in cement business primarily, you would be a new entrant in that market?
I can't agree with you more, but then the decisions will be taken based on the exact availability of permits and clearances. So as a company, we are pursuing both this. And as I mentioned, I think in the quarters to come, we would have better clarity on which one will kickstart first. But we are fully seized of the growth opportunity in North. And you would know, a year ago, we never mentioned about the grinding unit in Bhiwani. But now, during the course of the year, we realized that North is a great opportunity for us to expand. And hence, we are embarked on a brownfield expansion of 1,000 TPD clinker in Nimbol and setting up a 1.2 million grinding unit in Bhiwani. That would take the capacity of the company from current 4 million tons in North to close to 5 million tons in North to 6 million tons in the next 12 to 15 months. Even now, we are not utilizing the full capacity in North. Currently, we are utilizing close to about 3.5 million tons of capacity in the North. So with the new grinding unit and the clinker debottlenecking, we'll have a good 2 million tons of cement to be sold in the next 2 to 2.5 years. And that is more or less equal to setting up one line. So without too much of capex, we will have additional clinker, additional grinding, and you would also know that to increase the sales in North, we launched Double Bull in North. So we have two brands, Double Bull as well as Duraguard, and then with this brownfield expansion and the grinding unit, next 2.5 years, we are good at North to get 6 million tons, and I think we'll have breathing space to decide whether to kickstart North or to kickstart West. I think in the coming quarters will make us decide which way we go.
Great. Great, sir, for a detailed explanation. Thank you. All the best.
Thanks.
Thank you. That was the last question for today. And now hand the conference over to the management for closing comments.
Thank you, Gavin. Thank you for your questions. To summarize, while there will be some pressure on the near-term profitability, with costs mostly likely peaking and as we enter a seasonally weak period, however, things are expected to improve from quarter 3. Cement demand is expected to witness a healthy uptick in FY23 with the strong momentum in housing and government-led infrastructure development projects. We continue to focus on internal levers, operational efficiencies, and remain committed to our expansion plans at Bhiwani. We also continue to invest in debottlenecking projects at Vistas and Nimbol, along with alternate fuel material handling facilities as part of our sustainability initiative. My team and I in investor relations remain available for any clarifications required. Thank you for joining us today. All the best.
Thank you very much. On behalf of Nuvoco Vistas Corporation Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.
Thank you.